Hey everyone, welcome to another video. So in this video, we'll try and understand which is a better mode of investing into mutual funds. Whether you should go for the SIP route or the lump sum route. Now mutual funds, as all of us know, tend to give higher returns when compared to fixed deposits. In fact, today many people ignore fixed deposits and have ventured into mutual funds. And that is why in financial year 23-24, the growth rate of mutual funds around 34-35%, which is an all-time high. But for a beginner investor, the obvious confusing question is, okay, I want to start my investment journey through mutual funds, but which is a better mode? Is it the SIP method or the lump sum method? Let's try to find out through this particular video. Now, SIP investing or systematic investment plan is a mechanism wherein you invest a fixed amount of money every month, every quarter for a certain period of time. And therefore, the most important requirement here is discipline when it comes to this kind of investing, because you need to dedicate a fixed amount every month, every quarter, and invest the same in mutual funds. But more important than that, the best feature of SIP investing is rupee cost averaging, which means that in the stock market you have upward and downward arrows, and therefore, if the stock market is not performing well, your cost or your loss is sort of averaged out because of this SIP investing. Because you're investing a certain amount of money, irrespective of the condition of the stock market every month, every quarter, your loss when the market is going down is averaged out. Your return when the market is going up is also averaged out in the long run. To understand this feature of rupee cost averaging, let's take the case of an example. So say you want to invest into 1 unit of a mutual fund. The NAV at this first SIP installment is around 100 rupees. NAV is nothing but the net asset value, the value parameter for mutual funds. The NAV for your second SIP is rupees 80. That means the market is going down. But over a period of time, because you're doing a systematic investment every month, your average cost or loss is sort of averaged out. It is not 80 rupees, it is 90 rupees because it's 100 plus 8 divided by 2. It is the average of these two NAVs put together. So when the market is going down, you will not hit the rock bottom. Your loss will be averaged out. And when the market is going, similarly when the market is going up, you will not hit skyrocket. Your returns will be sort of averaged out in the long run. So next obvious question is, when do I know when to invest through the SIP route? Well, if you have a fixed source of income, be it salary or any other form of income which is regular, fixed over a period of time every month, then you can dedicate 10, 20, 30% of your income, set aside, give an auto mandate or an auto debit option, and invest the same into mutual funds. So in the case of regular source of income, you should think of SIP method or mode of investments. Coming to lump sum investing, which is the exact opposite of SIP investments. Well, here when you get a lump sum amount of money at a given point in time, you can think of lump sum mode of investments into mutual funds. It could be from a one-off property sale, performance bonus at your work. Once you finished your working career, you get retirement benefits in one lump sum. Or say your 5-year FD has matured, or you've received certain gifts in terms of money from your relatives. So when you get lump sum money, you can think of investing 85, 95% of that amount into mutual funds through this lump sum mode. So what exactly is the advantage of this type of investment? Well, you get the magic of compounding or compounding effect, because in a market which is rising, if you put a lump sum amount, let's say 1 lakh or 2 lakh or 6 lakh when the market is not doing well, and tomorrow if the market is doing quite well, then your returns will be compound over a period of time. It will be returns on returns, returns on returns, and that is the compounding effect. Let's also understand this concept of compounding through the help of an example. So I have two tables here and I'm trying to compare SIP investment and lump sum investment to understand this compounding effect in the long run. Say I'm investing 10,000 rupees every month for a period of 5 years, and my average rate of return that I usually expect or get is around 12%. So my initial outlay, or you can say over a period of 5 years, my investment cost is 6 lakhs. And at the end of the 5th year, my investment value as per this particular table is around 8.25 lakhs, of which 6 lakhs is my cost and the remaining 2.25 lakhs is my returns in value. Taking the same thing in a lump sum method, where at the initial step itself, I'm investing the entire 6 lakh, which was my cost total. I'm investing that on a lump sum basis and not on an SIP basis. Taking the same returns into consideration the same period of time, at the end of the 5th year, my investment value becomes 10.6 lakhs, of which 6 lakhs is my initial cost and 4.6 lakhs is your return. Almost double the returns when compared to an SIP method. Now, this is because your starting point in SIP was only rupees 10,000 for the first month or the first few months or whatever. But your starting point when it comes to lump sum method is already at rupees 6 lakhs. And because of this compounding effect, after a period of 5 years, your value investment under the lump sum method is much higher when compared to the SIP method because of your starting point and because of this magic of compounding. So the obvious thing that comes to your mind is, okay, then lump sum is sure shot the best method of investment when it comes to mutual fund investments. But no, this is not always correct, because only in a rising market your lump sum method investment is better or is more logical. In a falling market, your SIP method is better because of the rupee cost averaging feature which I discussed previous to this. This particular table also gives you a hint or an example as to why SIP or lump sum is not always the best method to invest. No single method is the best source of investment, best method of investment in mutual funds. Say here your selling date is 19 December 2023 and you have 4 investment horizons here. In the first case, say you're starting with a 3-year investment horizon. 3 years back you start investing and you're selling on 19th of December, you're liquidating or you're disposing of your mutual fund. If it was through an SIP route over a 3-year period, you will only get 15% when compared to a lump sum method where your annualized returns becomes 16.3. So here, for a 3-year investment journey, your annualized return under the lump sum method is higher when compared to the SIP method. Over a 5-year period, if you see, your SIP returns are much better than your lump sum returns. Over a 15-year period that you see, your lump sum investment returns are much better than your SIP investment. So depending upon the investment horizon, depending upon the rate of return and your mutual fund, SIP or lump sum could be the best method of investment into mutual funds. No single method is the best method. Well, if you ask me, in my opinion, which is a better method considering all factors, then I would definitely go for SIP, because one, it gives you the investment discipline that every single individual requires. Come rain, sunshine, beg, borrow, steal, you will have to invest a certain amount of money every month for a long period of time, and that is a good type of discipline that you should inculcate. Second one is, of course, peace of mind. You don't have to time the stock market or look at the stock market graphs at every hour of the day. Well, if you're doing lump sum investment, you tend to time the market, but under the SIP route, you can sleep peacefully, because irrespective of what the market is performing, if the market is high or market is low, you do your regular investments every month, every quarter. And the last feature is rupee cost averaging feature, wherein if the stock market is coming down or the market is not showing an upward trend, then your loss or cost will sort of average out in the long run. But more than all this, it is quite important that you take your first step of investments, whether if you're not taking it, whether it is SIP or lump sum, because 5, 10, 15, 30 years down the line, your corpus will look good, whether it is the SIP mode or lump sum mode, if you start today. Well, I hope I was able to make things clear through this particular video. If you like the video, please do show support to us by hitting the like button. If you want more videos like these on a regular basis through wave notifications, you could also think of hitting on the subscribe button. Till then, I'll see you guys in the next video. Take care and thank you.